I look at everything through the lens of don't lose money. And then, okay, once I have that covered, how do I try to make some money and have a respectable return? And so that's one way to do it, where you've got, you have the interest component on the underlying, you have this built-in optionality, but that optionality is only if it trades above 10. And then if you do one of these non-redemption agreements, you have optionality as long as the deal gets done. And
Yeah.
so I biased a little bit, obviously, but I think it's pretty powerful on a portfolio level.
From the investor standpoint, what do you look for in the team before you say yes to them, to deploy your own capital to them?
So this is where SPACs are so different from, I used to be a long short guy. It's
Okay.
just so different in that your downside to begin with. And so the bar for me to deploy capital with a team is lower than the bar for me to deploy my capital with a traditional equity security. Because when I was doing traditional long short equity, I was thinking about how much money can I lose? Could you trade down 20%, 30%, whatnot? Here, I'm thinking about, okay, I know that my money is buying your shares and you're holding the capital in a trust account and that's earning interest. So my downside is covered. So now I'm thinking, are you the team that can generate upside? And so that's digging in, and it starts off with, are you a serial sponsor? And if you are, how have your prior deals done? And it's even more nuanced than that, because it's how have they done before your deal closed and how have they done after they closed. Because you have a couple of these deals that trade poorly afterwards or better afterwards versus before. And since I know I'm most likely going to redeem, I want that optionality sooner rather than later. And so I'll give you an example. You look at a team like Churchill. Churchill just IPO their 11th SPAC in their franchise. And to be fair, that they've had mixed results, but they have a high percentage of completing a transaction. They have a great track record of raising capital. So you feel good that good things can happen. And in their 10th SPAC, which is called Churchill 10, they did a great transaction, and the stock right now is trading at $14.50. And so, you had to pay up because they're a premium sponsor, but in this case, you're rewarded for that. That's not always the case, but again, everything is underwritten in my mind through the lens of, I know what the downside is, and so like, how do I find the right teams to give me the upside? And from a portfolio standpoint, you really want to have that balance of, I want the guys that maybe offer more attractive yields based on where they're trading, but I also want that upside optionality as well.